Well, in 2016, global share markets have started on a very weak footing and the selling in pressure has been pretty intense across all regions. It's been dominant, of course, in the emerging markets, in the US, but all major regions are down. A lot of people are out there talking about that it's China related, it's oil related. However, I don't accept that view. I tend to think the key issue here is tightening US financial conditions. In the scheme of things, what happens in the US matters for investment markets because the US dollar is the dominant global currency in the global financial system. So what we've seen over the past 2 years is that the US Federal Reserve has ended its assets purchase program, they've initiated the tightening cycle, and we've also seen a very sharp appreciation of the US dollar. What's happening in the US and its monetary policy is pretty much flowing throughout the world, and given the fact the Fed's going to continue to hike this year, the US currency is likely to trend higher. I tend to think this volatility is likely to persist. Well, over the past 5 years, we have consistently talked to investors about the 3 Ds which are limiting the pace of global growth. And they are debt, demographics and disruptive technology. And although that we've had consistent flawed forecasts from central banks and consensus that the growth outlook is going to improve, in the scheme of things, I remain resilient in my views that nominal growth is scarce in the world and it's going to remain that way. In the end, unequal societies which have high debt and little population growth are destined for weak growth. And whilst we saw this in the advanced economies upwards of 10 years ago, it's now also started to impact the emerging markets. And this means that there are very few places investors can hide and little authorities can do. So in the scheme of things, it's a weak growth world and we need to factor this into investment thinking. A structurally weak expansion means that first of all there's a smaller growth pie for corporations to feed off, and secondly it's much harder to generate inflation, and this has delivered half of corporate earnings growth over the past 50 years. So what that really means, of course, is that what we're going to see this year is pretty much what we saw in 2015. In which there were very few asset classes or asset sectors indeed which delivered returns of 5% above inflation. Of the 4 investment classes which delivered better returns, 2 of those are going to struggle this year, namely European equities and Australian REITs. So what it really means is we're in a low return world, and if returns are lower, what that also means for investors is they need to reduce the risk in their portfolios, buying operating models which can grow earnings in subdued conditions, firms with strong balance sheets. In the end, there's time to take risks in portfolios and there's times when you need to reduce it, and I tend to think we're in one of those times. Well, I think the region which has got the best prospect for 2016 is Japan. You have widespread corporate reforms, you have a still supportive currency, and you have a rising terms of trade from falling commodity prices. So I tend to think Japan's likely to outperform its international peers. When we look then at the US, it's likely to have very low single-digit EPS growth, but I think that could be swamped by valuation declines as the US Fed normalises interest rates and financial conditions continue to tighten. When we have a look at the other side of the Atlantic, most of the outperformance of Europe that we've spoken about in the past year, I think is now behind them. It's a region whose recovery remains very lacklustre. Corporations haven't been able to deliver on earnings growth, so I tend to think that that's a region which is really going to struggle this year. And whilst they're going to struggle, I tend to think the worst returning market is going to be the EM, the emerging markets. And the reason for that is I tend to think that consensus forecasts of double-digit earnings growth are just completely unrealistic. Valuations are now trading above the 10-year average. And when I look at the region, I think that a long multi-year deleveraging cycle is about to begin as the US normalises interest rates, carry trades unwind, and property price declines prohibit or prevent further credit growth. So in the end, that to me is a market which is really going to struggle this year. Well, in December last year, the US Federal Reserve increased official interest rates for the first time in 9 years. And in the document which is accompanying the rate increase, they've suggested there are 4 more in line in 2016. Now, that's certainly not my base case. I don't believe that the US economy could cope with 4 rate increases this year. And if they were delivered and bond yields rose above 3% in the US, I tend to think there's to be odds on they'd fall into recession. So I tend to think you're likely to get 2 rate increases, very low risk of a third, but I just don't believe you're going to get all four. If they did all four, I tend to think you would get a much sharper sell down in US equity markets because financial markets are looking for two. But the interesting thing is if they did that and US growth really started to fall, you might actually get a rally in bond prices, which would be unique. Normally when Fed hikes, bond yields rise, but this time I actually reckon bond yields would fall. And the reason for that is you'd get capital inflow into bond markets, inflation would decline further, and growth would naturally weaken. I don't think they can possibly deliver four. There's no doubt central banks have been very supportive for risk markets in the past 8 years, but I think in 2015, 16 and 17, they're going to be an increasing source of global risk. And the reason for that is in the last couple of years, the central theme of central banks has been policy divergence. Fed's been tightening, Europe, Japan and China have been easing. I think the real question for central banks in the next couple of years is really policy sustainability. What's going to be the pace and the nature of the US tightening cycle, and can Japan and Europe and China continue to ease policy, given that it's pretty clear those policy easings are not really supporting the economic environment and not really having a sustained lift in global growth or in regional growth. So I tend to think they're the major source of risk this year. Other things, there's a lot of political risk also this year. We have national elections in the US, in France, in Germany, and of course if Angela Merkel is not re-elected in Germany, I think people will start to question the whole sustainability of the European project. You add to that financial instability potentially in China, in Saudi Arabia, and so on. I tend to think it's pretty clear that we're in a lower growth, higher risk world, and as a result, people may need to alter their portfolio construction to adjust to this new world.